G'day there, investorholics and friends. Today we're going to take a look at the main points taken out of the Berkshire Hathaway meeting. Speak to me, Warren. Well, hello there, investorholics. This is Scott. Crack the Sky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. So a quick look at the Q1 results. So everything's been affected by the COVID-19 pandemic, so there's no real bright spots except the cash balance. We'll have a quick look at the bottom. So operating earnings of 5.8 billion. We have an investment loss of 54 billion, which is effectively just a paper loss because the shares that they own are down. Earnings per A share were down $30,000. Earnings per B share was 20.4 minus, I should say. And we also saw that they have cash and equivalents on hand of $137 billion. It's a lot of cash. So a quick look at the top holdings. Most people know these anyway. So we've got American Express, Apple, Bank of America, Coca-Cola, and Wells Fargo. So a lot of those he's held forever and a day. Just good to have a quick little overview. So I think Berkshire holds over $180 billion in common stock. So that's publicly traded companies. So as I said, most of his values in those five on the screen there anyway. So as we've seen, there's been a lot of publicity about Berkshire getting out of the four large US-based airlines. So pretty much flushed it all down the toilet. Pretty much because the economics of the future isn't looking any good. So it cost him about $8 billion to buy a stake in each airline. He got out, back in his back pocket, I should say, for about 6.5 billion. So pretty much there was a $1.5 billion loss. So he acknowledged that he made a mistake by investing in the four largest airlines. He also said that there's just going to be too many planes, and also he thinks the world has changed for airlines, so just people won't be flying as much. So the economics aren't there, and they're not going to get the return on their investment that they thought they were going to get, so they're just getting out without any hassles, I suppose, cutting it off at the head. So everyone knows that Berkshire like to go elephant hunting with all their cash. So Warren definitely has his elephant gun loaded. He said that we haven't actually done anything because we haven't seen anything that attractive. If something arrived on Monday morning, they could invest sort of $30 to $50 billion. If they liked it, they would do it straight away. He's definitely got the cash and the will to do something. Just the opportunity just hasn't come up that's been decent so far. So Berkshire is battling the tyranny of its own success to a certain extent. Just physically their size, so beating the S&P and attaining a 15 to 20% return on capital by investing the vast piles of cash that the company now generates is becoming increasingly difficult. So you can't do those small deals anymore they used to do back in the 1950s, 1960s. So just don't actually make any point, to the bottom line of the company. The main reason he touched on that they haven't actually been able to find any really good deals is the fact that there's pretty much a lot of cheap money around. With interest rates at zero or negative or close to zero, it's quite advantageous for people to get, or companies to go and borrow some money at the moment. And also there's a massive Federal Reserve bailout, and that also just pretty much took the pressure off a lot of companies, and they're the type of opportunities that Berkshire usually look at. So pretty much there were some early deals come through the door, late February, early March type thing, but pretty much it's down to zero now, and those things that come through weren't of any interest to the guys anyway, Berkshire. So there's a lot being talked about there always is a lot spoken about the intrinsic value of Berkshire stock. So Warren didn't think that Berkshire was much more compelling value now than they were 3 to 6 months ago. Warren thinks that Berkshire's value has declined roughly the same amount of the stock price. That's sort of 19 to 20% depending on which date you pick. And that might be a bit surprising, but there's still a lot of analysts and people out there buying Berkshire, the stock. Not many people can afford the A's, but definitely having a nibble at the B's. So really the unknown is what the future holds. I think the main flux or main gist of the whole presentation was, I think he's actually being very careful. The worst is unlikely to be behind us, and caution will serve you well in preserving and growing your wealth. So there's definitely a cautious feeling coming from Warren when you watch the annual general meeting. So we never bet against America, and that's one of Warren's big things that he always mentions whenever you hear him talk, or 90% of the times he mentions that. So he still advocates backing the industrial might of American economy when you're looking for your investments, and that's definitely borne out in the tech sort of sector at the moment. So Warren still believes that America is the best country to be born in, even today. So he's saying that it's an incredibly young country, and they've accomplished a lot. It's been miraculous, and like he said, they'd never bet against America because he thinks that they can still outperform. So with reference to the average investor, he said that it's very unusual for money managers to beat the market, and that the money is in the selling. People selling the people on the slim hopes, so the big gains and that type of stuff. So the average investor should still buy the index funds and hold the S&P. So with the Australian reference, you might buy IVV for instance, if you're looking to invest in American equities, or if you're looking to maybe do the same thing for the Australian market, you buy VAS or IOZ or STW or one of those. So yeah, I think Australia's still got some good investment options, but if you're not that way inclined, buying the index is definitely the best way to go about it. So in the back of Warren's mind, he's very conscious about behavioural changes, and he's not really sure how that's going to work. Nonetheless, I think he's still quite optimistic about the future, although he did look a little bit tired in the 4.5 hours or however long he spoke for. So he's saying that the range of possibilities on the economic side is still very wide. Anything can happen. So in his mind, there's still a lot to play out in how the COVID-19 will actually affect broader economics and how fast you can actually get back to almost how our life was before, if that's actually possible. So it may take many years to assess the full impact of the current protracted sidelining of the US economy, and that's the same in Australia as well. So including effects on how people think. When people get their freedom back, will they travel? Will they go back out and buy clothes and eat out again? We know that they're buying clothes because internet sales have gone through the roof. Only time will tell. Where are the big changes in the global economy? In which industries will the structural changes occur? Are there any bargains in those areas at the moment? So where can we find investments? I mean, this is just me talking here, but this is kind of the way I look at this whole thing. Where can we actually find opportunities? Because definitely things will change after this. So where are the winners out of this situation? So following on from the theme where Warren's sort of unsure about how the future is going to turn out, at least in the near term anyway, there was a bit of a focus on capital preservation. So Warren spoke about being the trustee of Berkshire Hathaway, which is a bit different to how he normally speaks. And he's managing the company for the worst case scenario. So he's still quite worried about what's going to happen with all the shutdowns and how things will open up again. So at the worst case, they still have a huge stockpile of cash. And if the worst happens, that'll actually be a smart move. But if everything turns around and changes fast, I'm sure people will be jumping on him and telling that he's done the wrong thing. So it's interesting that Berkshire also borrowed some money in the last quarter, effectively because the rates were so cheap. They kind of mentioned that it was actually Berkshire Energy. I think they actually took out some small loans and some other one of the other insurance subsidiaries. I think that's what it was. He made the point that, going back to how much cash they've got, he made the point that they're not going to rely on the kindness of strangers or friends to assure the future of Berkshire, so they're definitely self-sufficient, and that sort of rolls back right into the whole capital preservation. That he's not rushing out to spend his money on just any acquisition. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.